Hello, welcome back to my YouTube channel. Today I'm going to talk about, is marking time a good idea or not? At least to me, market timing is not a myth. Okay, so I'm going to show you why that is not the case and how you can use certain techniques to understand when to invest, when not to invest, so that you can maximize your profit in the market. So, without further ado, let's get started. So, you might have heard people talking, about market timing, whether it's good, bad, or ugly. So, on one camp, people always say never time the market, just buy it because investing is always for a long term. But you might have also heard people saying that, sell high and buy it low. To me, this is also kind of market timing because you could never know when the market is low and when it is high, right? So when people say sell high, that means you need to know it is high enough to sell it, right? It's kind of timing, right? So for example, Warren Buffett, he was a value investor. He only buys a stock when it's low enough. So he is waiting for that opportunity. He is kind of timing the market, right? He is not timing the market on a particular security. You could argue that, but he is waiting for an opportunity for a particular security to get into a low value, which will enable him to buy at a very low cost so that he can then sell it high. But nevertheless, there is a market timing to it. Okay, that's my view. If you don't agree with me, please comment on the comment column. I will look into it. So for years, the investment industry has tried to scare clients, right? They always say that, you know what, you cannot time the market, so please keep investing so that you doesn't matter how the market is, how the economy is, because you cannot really time the market. And also they say that studies shown that market timing does not work. Well, there was a study done by Professor Javier Estrada, a finance professor at IESE Business School at the University of Spain. He found out the importance of those few big days. So there are big days in the sense, like for example, there are best days in the market where the market goes really, really high. And if you're fortunate enough, if you had your money invested, the return that you get on those days cannot be, that is the most you would get when compared to in an average in a year, right? So he tried to study the bigger days, like missing the 10 best day, missing the 10 worst day, and then staying invested. So what was the result? So the red one shows if one missed the 10 worst day in the market, what was their return? The green shows if you have invested regularly, like an average Joe like me and you, just dollar cost averaging. And the blue one is the one he shows if they missed the 10 best days, meaning the stock market is performing really well, but then you haven't invested anything. Okay, basically you stayed out. That's what it means. When he says missing the 10 worst day, meaning you somehow you avoided those 10 days of the worst slump in the market by not investing, perhaps, right? And then the green one is like regardless of how the market is, you keep investing. So most of the people are right when they say that, don't time the market, just keep investing. As you can see, the green one does the average, right? While interestingly, let's say if somebody times the market, by missing the 10 worst day, their returns are the highest amongst all the three. And the one who missed the 10 best day, they are the lowest, right? So you could see there is an argument to be made here. By missing the 10 worst day, one could get a biggest return compared to the one who is always investing. So this is why there is a merit to the saying market timing is not a myth. Okay, so this is a serious study. This is not like me doing this is not my study. This is like a study done by a finance professor, and he has shown, he collected the data all the way from 1998 to somewhere almost 1998 to close to more than 20 years. So you could see it's not like I'm not saying without any fact. This is the fact. So if it is clearly shown that there are ways to time the market, and if you could time it appropriately using certain techniques, you could get the best results. But funny enough, the finance industry doesn't want you to know this, because they always tell you, because they cannot make money when you have everything in cash. They make money only when you are invested. So they always advise you not to be in cash, keep investing. So you could get the average return, which is not bad for most of the people. But if you apply yourself, if you put some effort, the study suggests you could get more returns. So how can you do that? So let's dive into that. So you don't need to, let's say the market goes down, it doesn't mean that you are all out. Or when it is going up, it doesn't mean that you need to be all in. Because even like Warren Buffett on the value investor, they try to buy only when they see value. It's not like they go and buy the securities every day in, day out. They use certain techniques to understand, and then they invest accordingly. So for example, you can use some technical analysis and fundamental analysis to reduce the risk in your portfolio. But keep in mind, these may not be accurate, but as we saw, by using certain techniques, you could definitely optimize, get the best results. So for example, this is how I do. Basically, I use 50-day moving average and 200 moving average as an indicator, and when they cross each other, that will tell you whether the market is in the bear territory or in the bull territory. So for example, this is a S&P 500 chart. It's plotted for last 5 years, and you could see when the blue ones goes beyond below the 200 day, then it's like in the bear territory. And if it is go above the 50-day moving average goes above the 200, then it is in the bull territory. So based on this, I go and invest my money, and I can kind of time the market and then optimize my good, basically maximize my profit. So for example, if the market is down, right, like I know, like once the 50-day moving average is down, goes beyond 200, I know now the market is in bear territory. I know from the past, like when people always say buy low, I start putting more money than normal. Like for example, what do I mean by that? So when the market is already high here, I know anytime it may come down. So instead of putting lot of money here, I put like little bit, every now and then, depending upon the day. If it drops, maybe I add little bit, but I don't invest too much at this point. But as soon as it gets down to this, let's say I have the S&P 500 index fund, I start to put enough money, because I know the stock market in the long run, they will do better, right? So as soon as it goes, the 50-day moving average goes below the 200-day moving average, I start to put more money than I regularly do. And then once the 50-day moving average crosses the 200 moving day average, I start to be cautious, but I keep going until I find a point where it crosses down. Then, like once it keeps going for longer period and the spread is like really lot, I try to be cautious, and I put like not a lot of money, but like small chunks here and there, right? But as soon as it goes down, like here, I start to invest quite a bit, right? So just to give you an example, like between here to almost here, I invested maybe like 50K, right? And then starting from here, I did not put that much. I was like kind of nibbling here and there, because I still want to participate in the market, because I don't want to miss the 10 best days. So I just keep adding it, but not too much. But as soon as I got to this point where I saw that 50-day moving average went below the 200, I start to put a lot of money. So this is a technique I use. I'm not saying this will work for you, but you see, by doing this, I kind of maximizing my profit, right? So for example, right now, as I'm recording this video, the market, we are in 2024, the market is already in peak. And I can see, like the market has been in bull run for quite a bit. So I'm now being very cautious. I'm, putting money, like not much, kind of nibbling here and there, whenever the market is down. I'm trying to find an opportunity, or like any stock that is not doing good, etc., etc. So I'm kind of like being very cautious now, right? I'm waiting for this opportunity where, the 50-day moving average will go below. Then I will plow the money. But now I'm kind of nibbling it a little bit. So you could apply some general principles, such as like when the market goes high, let's say if you have some securities, not an index fund, you could trim your position, right? You can take little bit profit. And let's say like if for example, your stock has gone down quite a bit, that like for example, the 50-day moving average has gone down 200 and the fundamentals are not good, it is better to cut off that stock. That's the best rule. And whatever money you trim it, like whether you trim it like by selling it or or selling the loser, you could use that money and have the cash ready, and then wait for this this crossover pattern, and then you can employ that money. So that's how I do it. So there are other indicators to do it. You have to find your technical principles that works for you. As I said, this may not be 100%, but what I'm trying to tell you is there are ways to time the market and be smart about it and maximizing your return. If you don't agree with me, please comment on the comment column. If you like what I said, and I think you can employ these techniques to your portfolio to maximize your return, I hope it added value to you. If you think it added value to you, please subscribe to my channel, hit that like button, share my video, and thanks for watching.